I'm a huge proponent of investing strategies that are simple, easy to understand, and even easier to follow. For the most part, things like day trading and stock options are useless to the average investor. So, with simplicity in mind, for today's video, let's talk about the 5 index funds you can buy and hold for the rest of your life. The first index fund you can buy and hold forever is an S&P 500 index fund. My personal choice is Vanguard's VOO, but feel free to choose other options like the famous SPY. When you invest in this fund, you invest in over 500 of the largest publicly traded corporations in the US. You own shares in companies like Amazon, Google, and Apple, and own shares in various industries like tech, financial services, and healthcare. The emphasis here is size. All of the companies in the index are gigantic. In fact, the total market cap of the S&P 500 is more than $30 trillion. The S&P is a forever investment for a couple reasons. The first is the instant diversification added to your portfolio. With over 500 companies across different sectors, you're definitely not putting all your eggs in one basket. Many of the risks some companies face will be non-factors for others. And the same can be said about stock types. The S&P offers exposure to growth stocks, value stocks, and dividend payers. The next reason is that the S&P has possibly the greatest historical performance of any investment ever. Over the last 55 years, the S&P 500 earned on average 10% annually. And although historical performance doesn't guarantee future returns, I believe 10% a year over 55 years is a testament to the fact the S&P 500 is a diverse selection of competitively advantaged companies. The next index fund you can buy and hold forever is a growth index fund. Again, my personal choice is Vanguard's VUG, but there's other alternatives out there. The index being tracked here is the CRSP US Large Cap Growth Index, which is a common one next to the S&P 500 Growth Index. With a growth-oriented fund, you'll gain exposure to those companies that are growing their revenue and other financials at rates faster than the overall market. The focal point is ramping up business operations to scale, gain market share, and outpace their competitors. These companies will forego paying a dividend in order to reinvest that capital into the business. And that's the thing about growth companies. They require a lot of capital to keep that growth engine going. So what about a growth index makes it a forever investment? Besides the general diversification, I really think it comes down to how growth companies are utilizing their capital. It's my belief that a growth company with solid leadership and focused direction can earn a higher return on a reinvested dollar than paying out that dollar to me, where I could earn roughly 10%. It's the company's collective expertise and experience that gives them a better understanding of how to invest dollars that will go the furthest. Let's take one of the most popular growth companies, Apple. Apple pays very little in dividends. Last I checked, yields were still sub 1%, but as a shareholder in Apple, I'm not necessarily upset about that. Do I really believe I can get a higher return on a dollar than Apple can? The same goes for Amazon and Microsoft and Google. My return on investment doesn't have to be a dividend when I know that money could be reinvested strategically and give me a better return through the stock's price appreciating. Another index fund you can buy and hold forever is a dividend index fund. And I know, I just got finished somewhat undermining dividends, but hear me out. When you invest in one of these funds, you're investing in a collection of companies that pay out an above-market dividend, measured by their dividend yield. These are companies that have reached a level of profitability that leaves them with capital reserves, or in other words, excess cash. Rather than reinvesting that excess cash, they pay it out to their shareholders. And what makes dividend-paying stocks interesting is that they aren't the most sexy companies, but they're certainly titans of their respective industries. Some common household names found in dividend funds are Verizon, Home Depot, and Coca-Cola. Boring? Kind of. But profitable, you betcha. There's quite a few dividend indices, but two very common ones are the Dow Jones US Dividend 100 Index and the S&P 500 Dividend Aristocrats. If I were to pick an index fund, I'd go with Schwab's SCHD, given the high yield. The type of investor a dividend index fund is for is an investor who cares about one thing: income. The amount of money you could expect to receive depends on the dividend yield. It's a percentage you get from dividing the dividend's dollar amount by the company's stock price. It can be interpreted as how much you'll be paid yearly for every $100 invested in the stock. Income investors want to see tangible returns on their money. They want to see the cash flow into their accounts. It's the real visible progress their investment is making. And what's a bonus is those dividends can be used to purchase more of that same stock so that the investor receives an even higher payout the next time. That's the dividend snowball that you often hear about, and a big component of passive income strategies. If you invest in these funds consistently over long periods of time, the ability to compound your dividends makes dividend index funds a forever investment. The fourth index you can buy and hold forever is a small cap index fund. All the funds we've covered thus far have been concentrated on larger companies, but there's an entire section of the stock market that's smaller. A small cap index fund gives you exposure to those younger publicly traded companies whose main objectives are breaking into a market and aggressive growth. Small cap stocks might be less stable than their larger counterparts, but here's a fun fact. Tesla, the stock that made Elon Musk the richest man on earth, was once a measly small cap. There are numerous funds to choose from, like all the others, but I've personally used iShares IJR, which tracks the S&P 600. Another more popular small cap index is the Russell 2000. You'll see the Russell referenced all the time on financial news channels. The main difference between the two is the amount of stocks in each. 2,000 companies is a lot more than 600 if diversification concerns you. A small cap index fund is a forever investment because of the upside potential. Like I said, many of those smaller companies are volatile, and a larger portion of them will fail to meet expectations. But the ones that do, they'll provide returns that more than make up for those other losses. Couple that with an investment in large cap funds, and you'll ride those companies' successes throughout each phase of their businesses. Imagine having invested in Tesla as a small cap and continuing to do so as it grew to what we know today. Amazon had a very similar trajectory. And I know performance should be taken with a grain of salt, but if you look at the last 20 years, the Russell 2000 outperformed the S&P 500. That's no easy feat. The fifth and final index fund you can buy and hold forever is a total market index fund. This one is a bit of a cop-out, and I feel kind of lazy including this one as one of the five, but the fact of the matter is, investing in a total market index fund is as simple and diversified as it gets. So rather than choosing companies of a specific type, of a certain size, of a particular strategy, why not own them all? A total market index fund is just that, a way for you to own the entire US stock market. The S&P 500, check. Growth stocks, check. Dividend stocks, check. And small caps, check. With a total market index fund, you don't have to worry about investing in the other four we've discussed. They're all packaged together. Owning everything over the long run is to say, you'll let the market determine which companies are worth investing in. The winners and losers across different industries are weeded out, and certain orientations, like dividend stocks, will perform in tandem with economic conditions. And the best part of it all, you don't have to lift a finger. So if that sounds amazing to you, check out Vanguard's VTI for a simple, no-effort way to own it all. To wrap this video up, I want to emphasize the underlying principles that make these 5 types of index funds forever investments. The first is diversification. Each index offers investors a level of diversification that would be difficult to achieve picking individual stocks. The second is cost effectiveness. Because each fund can be passively managed, the associated expenses are close to negligible relative to other options like actively managed mutual funds. And the third principle is possibly the most important: a belief in American industry. Holding these index funds forever is predicated on the US continuing to lead major segments of the world's global economy. If America does well, so do you. And that's all I have for today's video. I do apologize for not getting this one out to y'all sooner. I'm not sure if it's noticeable or not, but I'm a bit under the weather. I can't seem to kick this cold. Such is the way of the human immune system. Nevertheless, as always, thanks for watching. Until next time, take care of yourself and best of luck.